Hello everyone. In this video I will talk about size factors. So, size factor says that a small capitalization stock tends to earn a higher average return than large capitalization stocks over a long period of time. And this means a small minus big effect. It is similar to saying that you might be aware of emerging market and developed market. So generally speaking, emerging market has a higher expected growth rate than developed market. So generally graphs follows such kind of things, right? So as you become large and large, the rate of growth, if you consider the slope of this curve as a growth, then it becomes smaller and smaller. Similarly for these concepts. Now, how do we measure size? Size is measured by market capitalization of a stock, which is equal to price times number of outstanding share. This price is the price of one share of a stock. You must be knowing large cap, mid cap, small cap, and this is the categorization based on the some threshold of market capitalizations. So generally speaking, in India, it is around 20,000 crore. If it is greater than 20,000 crore, then we consider it as a large cap. If it is between 5,000 and 20,000 crore, then we consider it mid cap. And if it is less than 5,000 crore, then a small cap. So this is not a strict rule. It can change depends on the person to person, but this is what I saw in my domains. Now let's see how we can build portfolio using size factors. One thing to point out here is that whatever the portfolio that we are building right now is long short only, sorry, is long only, means we are allowed just to buy the stocks. I will cover one important thing in the coming video, that you can also make long short portfolio from each factors. So let's say we have Nifty 500 universe and I want to build a portfolio who having 20 stocks. Okay, and the style of selecting the stocks should be size factors. So similar to the past, we will take all the 500 stocks and then take market capitalization of that stocks at that point of time, and then we will take log market cap. So log M1, log M2 to log 500, log market capitalization of 500 company. Why we are taking log? Let's see. I mean, this is the curve of log. If this is M, then Y will be log M. So what happens, like in Indian market, there are a lot of companies whose size is very large, and there are few companies whose size is uh, like as comparable to those large company. So we try to make it in that scale. So when you put log M, it is decreasing the value, because if you see the graph of log X, it is like the slope is decreasing. So if the M is large, then the Y will be not too large, right? It will be in the scale. That's why we are taking log market cap in place of market cap. Now, just to make you remember once again, according to size factor, small cap stocks tends to earn higher average return than large cap stocks over the long period of times. So we will sort the stock based on log market cap and then rank it. We will rank in such a way that smaller the market cap, higher the rank, and then we will select top 20 stocks. Now we have top 20 stocks based on the size factors. How we can make portfolio to invest in the stock markets? In simple sentence, if I have to say, if I have 100 rupees, how can I invest 100 rupees to this portfolio, to these 20 companies? Should I invest 5 rupees to each company, or in proportional to something else? Let's see how we can make portfolios in a different way. So first is equate portfolio. In equal weight portfolio, as I told you, the weight of each stock should be same. And since there are 20 stocks in our portfolio, so weight will be 1 by 20, which will be equal to 0.05. Okay. Second is mean variance theorem. So in mean variance theorem, as you know that we have to maximize the objective, which is Sharpe ratio, and Sharpe ratio is expected value of a portfolio return divided by divided by standard deviation of a returns. Okay. So and the corresponding y star, the optimal y star will be the corresponding solutions. And third is weight proportional to log of market cap. Okay, so consider that y is equals to log x, right? Uh, it is the logarithmic of the market caps. So the proportion, like the weight of each stocks in the portfolio, will be proportional to this log of m divided by summation of log of mi. So this will be same for each and every stocks, and those stocks whose market cap will be higher will get higher allotted, right? So I think you must have understood how you can build a portfolio using size factors and what is the associated concept to each and every terminologies. Thank you. See you in the next video.